Studio with us, we have the CFO, the Chief Financial Officer of Stanbic, CFC Stanbic, Edwin Mucai, and we'll be discussing the first quarter results. Thank you for joining us.
Thank you too.
Your profit after tax nearly doubled to about 1 billion shillings. But if you look at the loan book, it grew just by 5% to about 67 billion. What would you say were some of the key drivers for the profits for the first quarter?
I think a couple of things. The first thing is that conditions have been very favorable to banks in the last, say, 6 months in terms of the macros. So interest rates regime has been trending down. If you look at the Treasury Bill rate, it's ranged between 8 and 10%. If you look at inflation, that's been between 3 and 5%. So the macro environment has been favorable to doing business. Unfortunately for Kenya, was the political uncertainty around the elections. So a lot of businesses deferred credit decisions. And what that meant is, 65% of our business is actually our corporate and investment bank. We also have a lot of mid-sized companies we lend to. So about 80% of our business, we do that with businesses. So we're not surprised that the loan book has not, shown great growth for that reason. However, we have a diversified business, and part of our franchise is our global markets business. We have a number of capabilities, including FX hedging solutions, and a lot of the strong performance has actually come from some of the clients who came to us and wanted to hedge out some of their FX risk, and we're able to do some good business with them.
But looking at the non-performing loans, we saw the total non-performing loan grow by by nearly doubling to about 1.19. Previously, it was at 912 million.
Yeah.
What were some of the issues that were also facing that also led to the surge that we're seeing in the non-performing?
Okay. I mean, the way it works is that the loans coming to impairment actually lags the cause of that impairment. So you remember that starting towards the end of 2011, going into early 2012, we had a very high interest rate regime. So a lot of what I would call consumer credit would have suffered, and there would have been some strain on that. So a lot of that effect to where people were not able to meet the obligations as they fell due, starting becoming NPLs as we went to the latter part of the year and early into 2013, and that's the comparison between March 2013 and March 2012, hence the increase here.
Okay, so now that we are seeing the central bank has actually reduced the rate by 100 basis points, and you're one of the banks that actually took the cue and also reduced their best lending by the same margin, 100 basis point to 16%. Yeah. Is that a cue going forward that you expect probably your loan book will probably swell a little bit faster?
Yeah, I think the conditions are now favorable for business. We've now had an event in terms of the election. We now know what the government is going to be for the next 5 years. We know what that government is about. So it's, all systems go for business. So we'd expect to see significant credit growth. I think we're well positioned for growth in what I would call mid-size corporates, what others call SME banking. I see that as a huge opportunity. We're very strong traditionally in corporate banking. So again, I would see some big ticket deals coming on that. And some of our investment banking advisory services will be in high demand. So I'd expect to see robust business activity. And even looking at pipelines now, those are pretty full. So we are pleased about that.
Okay. Yeah. I cannot have you in studio not ask this question, whereby we have seen the interest rates, your interest rates are about 16%. That is nearly double what the central bank rate is going at, about 8.5. Yeah. Why are we seeing this huge disparity?
Okay. I think it's an interesting question, and one which I actually get asked often. I think the simple answer is that government is borrowing at between 10 and 12%. Okay, so theoretically that is risk-free credit. Okay, so if you are going to lend to an entity that doesn't lose you money, that is 12%. Okay, for us to lend to companies and individuals where there is an element of credit risk, because we're betting on their future success, there's going to be a premium we attach to that to cover ourselves for our expected credit losses, and give or take that's 2 to 3%. So that takes you to already to 15%. Yes. And then we need to create an environment, systems, process, people, and make a return for our shareholders. So I actually think the difference between the rate at which the government is borrowing versus the rate at which we are lending to individuals, actually that margin makes sense.
Okay.
Yeah.
So going forward, you're likely to see the environment probably now, and letting the banks actually reduce it further.
Absolutely. I mean, I would expect to see that as macros continue to improve, and a lot of people, including unfortunately some of our politicians, think that there is a quick fix to this. A lot of all this is a system of gradual structural reform in government, in the economy, which allow an environment where interest rates trend down.